Have you ever wondered about the current state of the US Federal Reserve's policies and their potential impact on the economy? Today we delve into this intriguing topic. Picture a world entwined in complex financial systems where the US Federal Reserve's policies hold significant sway. In this realm, the Core Personal Consumption Expenditures Price Index, or PCE, is a key player. This index is the Federal Reserve's preferred gauge of inflation, providing a clear view of underlying inflation by excluding volatile items such as food and energy prices. Why is this important, you ask? Well, it's simple. The PCE's movements have a direct influence on the Federal Reserve's decisions regarding interest rates, which in turn impacts the economy at large. Now let's get a little more specific. In January, the core PCE price index was forecasted to rise by 0.4% on a monthly basis, a stronger pace than the 0.2% increase recorded in December. On an annual basis, the core PCE was projected to grow at a rate of 2.8%, compared to 2.9% in December. These numbers may seem small, but they carry significant weight. A stronger than expected increase in this index could lead to the US dollar gaining strength against its rivals. On the flip side, a softer than forecast increase could improve the risk mood and allow rivals to edge higher, making it challenging for the US dollar to maintain its ground. So, what does all of this mean for you? Well, it provides a glimpse into the complex workings of economic policies and their far-reaching implications. It illustrates the significance of the Core Personal Consumption Expenditures Price Index and how its movements can influence the decisions of the Federal Reserve and the state of the economy. The takeaway? In this intricate world of finance, every decimal point matters. Every percentage change can sway economies. It's a fascinating dance of numbers and policies where the music is played by the Federal Reserve and the tempo is set by indices like the core PCE. So keep an eye on these economic indicators. They might just provide a glimpse into the future state of the economy. Remember, the dance of finance never stops, and neither should our quest for understanding it.
Have you ever wondered how artificial neural networks, or ANS, are revolutionizing our financial world? Today, we delve into this intriguing topic, exploring how these intricate systems have become integral in the financial sector and are shaping the future of investing. Much like the human brain, an AN learns and adapts over time. It's a system of algorithms designed to recognize patterns. These patterns provide valuable insights which, when applied to the financial sector, can be a game changer. Imagine a world where we can predict market trends with remarkable accuracy, where we can identify potential risks before they become catastrophic, where we can navigate the complex world of investing with ease and confidence. That's the world ANS are helping to create. ANS provide a unique perspective on the financial market, analyzing vast amounts of data to identify patterns and trends that are invisible to the human eye. This enables investors to make informed decisions, optimize their portfolio, and mitigate risks, ultimately leading to better financial outcomes. Consider, for instance, the prediction of stock prices. An AN can analyze historical data, identify patterns and trends, and predict future prices with a high degree of accuracy. This can give investors a significant edge in the market, enabling them to make strategic decisions based on reliable forecasts. But it's not just about predicting stock prices. ANs are also used in credit scoring, fraud detection, and algorithmic trading, among other things. They can analyze a borrower's credit history, predict the likelihood of a default, and help financial institutions make informed lending decisions. They can detect unusual patterns in transaction data, identify potential cases of fraud, and alert the relevant authorities. They can execute trades at lightning speed, capitalizing on market trends and maximizing profits. In essence, ANs are transforming the financial sector, making it smarter, more efficient, and more profitable. They're enabling investors to navigate the complex world of finance with greater ease and confidence, and they're shaping the future of investing. As we wrap up, it's important to remember that ANs are not a magic bullet. They're a tool, a powerful one, but a tool nonetheless. They require careful management and oversight, and they're only as good as the data they're trained on. But with the right approach, ANs can be a valuable asset in the financial sector, enabling us to navigate the complex world of investing with greater ease and confidence. They're shaping the future of finance, and it's a future that looks incredibly promising. Remember, the role of ANS in the financial sector is to analyze data, identify patterns and trends, and provide valuable insights that can aid in decision-making. They're a powerful tool in the financial toolbox, and they're shaping the future of investing. Thanks for tuning in.
Ever wonder how the manufacturing sector's performance shapes monetary policy? Or perhaps how the current market dynamics reflect the manufacturing sector's health? In the past year, the manufacturing sector experienced a roller coaster ride, but recent reports show a silver lining. After a period of stagnation, we saw an improvement in the sector's health for the first time since April of 2023. The catalyst? A return to expansion in new orders and a slower contraction in output. However, this growth was not without challenges. Renewed decline in supplier performance and longer input deliveries reportedly hampered production. Factor in greater transportation costs, and we saw input prices soar to a 9-month high. The response? Firms hiked their selling prices at the fastest rate since April 2023. Output? Now cast your mind back to the last quarter of 2023. The US Federal Reserve paused monetary tightening, and market participants were quick to price in upcoming rate cuts. The odds favored June as policymakers continued to deliver the higher for longer message. Fast forward to late January. The Fed's monetary policy meeting and hotter than anticipated inflation convinced investors that policymakers won't be hasty with loosening monetary policy. The first rate cut is now more likely to occur in September. This shift in sentiment saw the US dollar trimming its panic-related gains. However, Europe's tepid data has constrained the euro's bullish potential. Despite this, the euro advanced against the American dollar, reaching a 3-week peak. Yet, it's evident that strong selling around the 1.0800 level is limiting gains beyond this point. Turning our gaze to emerging and Asian markets, we see a divergent path. Emerging market currencies like the USD, RUB, USD, TRY, and USD ZAR show significant sensitivity to external pressures. On the other hand, the slight appreciation of the USD against the CNY, coupled with the strengthening of the KRW and IDR against the USD, suggests a more harmonious interaction of different forces. In summary, the manufacturing sector's health has shown signs of improvement after a period of stagnation, influencing monetary policy direction. The Fed's decision to pause monetary tightening led to speculation of upcoming rate cuts, affecting the value of the US dollar. The euro's advance against the dollar is tempered by strong selling and tepid European data. Meanwhile, emerging and Asian markets present a divergent path, with different currencies showing varying levels of sensitivity to external pressures. As we move forward, any slump below the line separating expansion and contraction could revive speculation of a Fed rate cut amid renewed recession-related concerns. This could spur optimism for risk assets and weigh on the US dollar. As always, the future remains a complex tapestry, woven from the threads of countless factors and variables.